What's up, everybody? It's your boy Shawn CPA coming back at you with another video. Today we're going to talk about the difference between itemized deductions and the standard deduction. So this is a question I get a lot, especially from younger taxpayers. They want to know, they've heard the term standard deduction most likely and itemized deductions, and they've heard of people go, you can deduct your medical bills and you can do this and that, and then they don't understand why maybe their specific situation doesn't allow it or why somebody else's situation does allow it. So this video is going to explain what those things are and how they work. So the standard deduction and itemized deductions are personal deductions that are taken on your Form 1040, which is the personal individual tax return. The standard deduction is an amount that's set by the IRS that applies to everybody in a certain filing status. So there's the single, married filing jointly, married filing separately, and head of household amounts. And they're indexed for inflation, so they go up a little bit every year to give you a larger deduction as the cost of living and everything rises because of inflation every year. So in 2020, the standard deduction for somebody filing single was $12,400, and the standard deduction for a couple married filing jointly was $24,800. So the standard deduction is an amount that's laid out by Congress that a taxpayer can use to offset their revenue, their income, W-2 wages, passive income, whatever it may be, to lower their overall taxable income, which of course is the number that's multiplied by your tax rate to come up with your tax due or owed, or whatever you want to call it, your tax liability. Itemized deductions are essentially, it's what they sound like. It's a list of items, right? So like, let's say 4 or 5 items that you can add up, and if those things outweigh your standard deduction, you take that deduction instead. So you can't take both. You can't have itemized deductions and the standard deduction. So for example, I'm single. I file single status. My standard deduction is $12,400. But if my itemized list of deductions would be $18,000, I would take that instead. But I lose that $12,400. That's off the table now. So that's when people say, oh, I itemize. I don't take the standard deduction, I itemize. That's what they mean. And common itemized deductions are medical expenses, dental expenses, real estate taxes, home mortgage interest. So, you can deduct the interest that you're paying on the mortgage loan for your house. Same with the real estate taxes you paid in acquiring your home or selling it. And disaster relief. So for example, if the federal government declared that if you were an earthquake or a hurricane, God forbid, and the government said this is now a disaster zone, you can itemize an expense for that. Normally you can't. So these itemized deductions are essentially, it's grace from Congress. So this isn't like, oh, I bought a new laptop, I'm going to itemize that. Like that, it doesn't work like that. These are items that Congress has specifically said in the tax code, specifically, boom, 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 you can itemize those things. It's not, hey, I was walking down the street and I dropped my iPhone and it cracked and I had to go get a new one because you can't not have an iPhone, or can't have, not have a cell phone. I'm going to itemize that deduction on my tax return. I'm going to deduct that. You can't do that. Your home mortgage interest, insurance, things like that Congress has said, this is in writing. You can take that. Only those items can be itemized. Charitable giving of certain kinds, for example. And then if that amount is greater than your standard deduction, you take that amount against to offset your wages, your income, to lower your tax liability. Or if maybe you itemize and it comes out in your taxes that, your home mortgage interest and your dental insurance, whatever you had, the few items, you might not have all of them, whatever they are, it comes out to like $6,000. Then you take the standard deduction. All of those things just get thrown out. Those they don't surface somewhere else for more deductions. They're just kind of, all right, I can't take my home, my mortgage interest deduction. Cool. That's off now because I'm taking the standard deduction. It's not like, okay, I'm going to take the standard deduction and then I'm going to I'll find another way to put that expense and deduct it. It's one or the other. So that's what people mean and accountants mean when they talk about, are you itemizing, or we're going to itemize this year, versus, oh, you only qualified for the standard deduction. They're two separate things. So that's how those two things work. I hope you learned something from this video. I hope I was able to provide some kind of clarity around that. If you enjoyed the video, please give it a thumbs up, comment, like, subscribe, hit the bell notification. All that stuff helps the algorithm and helps the channel grow. If you have any questions, leave them in the comments below. And if you need to contact me for help on your taxes, just look in the description, and all my contact information is there. You can hit me up on social media, whatever you want, and I'll definitely respond. Thank you for watching. Again, my name is Shawn CPA. I'll catch you in the next one.